Well, welcome everybody as normal. Welcome to biweekly class 18. I double checked. This should be the right number this time. We usually get the numbers wrong.
That doesn't seem correct.
No?
I feel like we've done way more than that. I don't know.
Okay, well, it's around
Regardless,
18, if not 18.
A lot.
Yeah. But today's class, we're going to be going over market correlations. This is something that we've been talking about a lot recently because it's actually being able to be fed into our plays, at least in my own trading. I know Austin's also been taking some correlation plays. But today, we're going to go into just a couple of them, really, and then also how to utilize them yourself in your trading.
Yeah. In the general concept of what market correlations are, right, and
Definitely.
how you can use them to your advantage, right? Understanding market context, how things move, can give you a big edge in the market. So
Absolutely. So let's go ahead and get started. And I thought the best way to get started would be to kind of define correlation for us. So a correlation is a mutual relationship or connection between two or more things. And it's also worth noting that when we're looking at correlations, there's two different kinds, really. There's positive correlations and negative correlations. Positive being two or more assets that move together. An example that we threw in here is NASDAQ and Bitcoin. As we know, as of recently, and we actually go over this a little bit later in the slideshow, QQQ, or the NASDAQ, has been very correlated. Yeah. Tech in general has been correlated with the price of cryptocurrency. And on the other hand, we have a negative correlation, which is just the opposite, where two or more assets move opposite of each other. In this example, we brought up SPY and gold, and I put in italics here that it's usually, right? As of recently, we've seen both things moving to the downside, but usually SPY and gold move in negative correlation with one another.
Right, because when things are very bullish and risky, right, people want to have their money in equities, right, like stuff on the stock market, and then when things get kind of scared and the market is pulling back, people will look for safety in stuff like gold, usually.
Which is what we're going to go over right now.
Yeah. Okay, cool. So risk on versus risk off, kind of what we just talked about. Correlations revolve around capital flows and where money is going. Having a firm understanding of risk on versus risk off assets gives you a very good understanding of correlations and why they exist, right? So as we said, risk on assets or risk on investments have the expectations for further economic growth, right? So risk on stuff like your cryptocurrencies, your stock market, stuff like that. Even to some extent real estate, right? Risk off expectations for further economic growth are low. So when things are looking rather bearish, it looks like that the economy could go into a recession. You're going to want to have your money in risk off assets like commodities, the US dollar, or lower yield bonds, right? And we can see here, there's a few examples of risk on assets and risk off assets. And these correlations aren't always perfect, as we mentioned, right? We've actually been seeing gold go down with equities. So they're not always perfect, but typically these are very good examples of risk on assets and risk off assets. Logan, do you have anything to say about how sometimes they don't always correlate with each other?
Well, I think that's a very important part to note. Not always do things correlate together, but that's actually when it presents the most unique opportunity for us as traders, because knowing what things do normally correlate can give us an idea of, if there's a divergence between two things that are normally correlated, you can trade back to the mean, or where things are usually correlated.
Right.
And we go over that.
Something's not priced in, right?
Yeah, exactly. It's kind of like an arbitrage strategy, but that's something we do go over later in the slideshow as well, for sure. Very important to set that expectation. And I think having a firm understanding of risk on versus risk off gives you a really good framework, really, for identifying correlations.
Absolutely. This is probably the best one. Yep.
So we wanted to go over the thing that most people care about when we're looking at correlations, and that is the United States dollar. And the United States dollar plays a very special role in financial markets worldwide, as it is, as everybody knows, the world's reserve currency. And a quick stat here, 88% of the trading volume in the foreign exchange market annually is the United States dollar. And the foreign exchange market is a $4 trillion a day market in terms of volume. So that is a lot of USD transactions taking place. So most things we look at are priced in USD. You'll notice oil, crypto, think XXX USD or BTC USD, Ethereum USD, bonds, stocks, etc. As the dollar gains value, that in comparison drives the prices of these items down as they are priced against the dollar. So higher dollar prices usually result in lower prices in assets it is priced against. And then some examples we have here are stocks and commodities. For stocks, as the value of the US dollar rises, the US stock indexes tend to fall along with it. Over the last 20 years, the rise in the value of the US dollar has had a slight negative correlation to the movement of the S&P 500. So about 60% of the time, The S&P goes down when the dollar goes up. And for commodities, there is normally an inverse relationship between the value of the dollar and commodity prices as well. The influence of the dollar is that commodities are global assets, obviously. They trade all over the world. Foreign buyers purchase U.S. commodities, or really anywhere, right? Anywhere that's selling commodities, such as corn, soybean, wheat, and oil with dollars. Most transactions are done with dollars. And then when the value of the dollar drops, they have more buying power because it requires lower amounts of their currencies to purchase each dollar that is being used for that transaction. And classic economics teaches us that demand typically increases as price drops. That was a lot. Austin, do you have anything about, the dollar's correlation with stocks, commodities, whatever else?
Yep. So what I was going to say here is that the term cash is king is really just reference to when things are bad, the king of everything is going to be the world reserve currency.
Right.
And we've seen the world reserve currency kind of switch hands a few times. I believe the last one was was it the pound? No.
It was I'm actually blanking on that one.
Yeah.
There really wasn't one
Google search.
Besides gold,
What's up?
Right? Everything was priced or backed by gold until the U.S. took over in World War II, usually. It's my understanding.
Right, yeah. Correct. Well, okay, yeah. Never mind. I'm going into Great Britain actually held it for a little while. That's what I was thinking of. But yes, it was on a gold standard for a while, and that does kind of fit into here. But yeah, whatever the world is using as its recognizable reserve currency, right now it's the U.S. dollar, that is going to essentially be king through tough times, right? And understanding that is very important. I mean, I guess you guys can understand, right? I think lately, especially, it would be better to have the majority of your net worth in U.S. dollars rather than some of these equities and cryptocurrencies and stuff, right? Because a lot of the stuff is suffering to the dollar. So understanding cash is king and really actually getting to live it is important, right? We're seeing it happen right now. So, yeah.
Definitely.
Even during times of inflation, right? Inflation's still high, but the dollar's still going up. So, yeah, quite interesting. Okay, so moving on, we have stock market correlations. This is, as we say here, a fairly straightforward section. Think of a business that relies on specific materials, and when those materials fluctuate, so will the price of the stock, right? So many companies that we know and love all kind of revolve take place in their own individual markets. Down below, we have some sector correlations. All stocks in one sector are more or less correlated with one another. For example, AMD and NVIDIA move very similarly compared to one another, just like how Lucid, Tesla, and General Motors are very similar as well, right? The effects of commodities, materials, and anything that kind of goes on in that sector will affect all of them. So understanding those correlations is very, very important. I'm not sure why you have AAL here. Was that a typo? Sorry.
No, I'm saying... comparing the price movements of AMD and NVIDIA, they move very similarly compared to the price movements of AMD compared to AAL.
Oh, okay, right.
There's
AMD
a higher correlation.
And AAL have nothing to do with each other.
Correct.
Right. Yes. Okay. My bad. I read that wrong. But that makes sense to people, I'm sure. So yeah, and then we see here a common correlation that people rely on is the S&P 500 and VIX, which is the volatility index, right? Now, it's not a complete correlation. They're not complete opposites of each other, but obviously when VIX goes higher, the S&P 500 tends to go lower, right? So there's a lot of correlations within the stock markets when you consider the sector that they're in, the materials and the resources that are used for these companies, and also just like volatility indexes, right? And inverse ETFs. There's a lot of stuff that correlates with one another. Logan, I don't know if you have any thoughts on that, but
nothing really else. The example that we had above was semiconductors getting hurt when prices of lithium, nickel, gold, and aluminum prices go up. And then the other thing was, price of energy stocks as the price of crude oil fluctuates, which is something we've been using quite a lot. Recently,
right?
More so recently, yeah, for sure. And that brings us into asset class correlation. And I do have some charts here that we definitely need to go over. But most asset classes will be correlated in relation to the health of the economy. If the economy is running hot, so will indices and stocks and REITs, a real estate investment trust, futures, investment grade bonds, etc. If the economy is not doing too hot, those names will underperform, and you will see commodities and other risk-off assets take the spotlight. And then the charts we have here is you can see the price of AUD/JPY in the S&P 500 are positively correlated, but for a period of time, they diverged, causing a very large discrepancy between the two. AUD/JPY moved lower when SPY or the S&P 500 moved higher, and then eventually that correlation came back to its medium, which would, again, like we were talking about earlier, present an interesting trade idea for us. or at least something similar to that, if not that exact situation. And then the other chart that we have here is the correlation as of recent from Bitcoin and U.S. tech stocks. So you see Bitcoin's correlation with U.S. tech stocks has reached a record high as of recently in 2022.
Yeah, and I think it's very important to see in these visuals, right? It's not, these correlations aren't permanent, right? They kind of happen for periods of time, and then they'll kind of diverge again, and sometimes, you know, they'll reach higher extremes or lower extremes, right? And I think the Bitcoin example is a great one. Like, it's making an all-time high where with its comparison to that of tech, right? You can see that there was some times in the past decade where it was very much the opposite of tech, right? Like, tech would be doing one thing and Bitcoin and cryptocurrency would be on the complete other page, but now they flipped and they're together. Just like the S&P 500 and AUDJPY, that's another very, very interesting chart. So, yeah, could make for some very good trade ideas indeed.
Definitely. So we do have a guest that wanted to come up and share with us about the market correlation matrix.
Hello.
Hello, sir.
Thank you for welcoming me. I mean, this visual, if some of you have taken maybe a stats class or what else would they show this in? Maybe an investing class or something. I saw this in stats for reference. But basically what this is you'll see these numbers are what they're called are correlation coefficients. So the way that these are measured are from -1 to +1. Right? And you have your negative correlations, which means things go opposite of each other, and you have your positive correlations. That means things go congruently with each other. So when we look at some of these numbers, you can see they're, highlighted for green being the most, and a 1.0 is the highest you can get. So obviously, if you can match up S&P with S&P, it's pretty self-explanatory. But looking into it a little bit deeper, and can you zoom in, Logan? I apologize, I can't really see.
I unfortunately cannot, but I can read it
see.
for you.
I can bring my eyes closer to it. Okay, so one thing again that this is outdated, by the way, just to let you guys know, this is just 30-day data for some of these stocks around 2020 or 2021. So take the data with a grain of salt, but just observe the relationships that you find in these things. So one thing that I think is very easy to point out if you want to say, okay, what can we look at for higher correlation? And to give you a bit of a reference, the only thing you really need to understand is that a 0.7 above, a 0.7 to 1 means that there is a very, a high positive correlation, and vice versa, negative 0.7 to -1, a high negative correlation. So those are the numbers we'd want to keep in mind. So if we take a look, for example, at the time that this data was plotted, the SPY ETF and, if I'm looking correctly, Microsoft stock, that was a 0.82 correlation. So for this 30-day plotted data, the S&P and Microsoft basically were moving pretty close to each, like very close to each other, actually. And then we can look vice versa at something like, let's see, let's take what's a good example, Logan? I'm trying to find.
Well, we have on the other extreme side of the situation, Euro USD compared to USD CHF, which is USD Swiss franc, has a negative correlation of 0.7. So that would be a strong inverse correlation.
Right.
Yeah.
So, I mean, it's pretty self-explanatory on its own, but I think an interesting activity that you could do, and if you have Excel, my Excel license just expired, but this is very easy to do in Excel. If Logan, I don't know if that's something, I wish we could have shared it before, but it's kind of just popping up in my head. If you put, two X and Y columns on an Excel sheet, and you plot the price action, you could put, I don't know, Apple and let's just say Tesla on two columns, and you plot the price action for however long, 30 days, 60 days, 90 days, you plot them along those two columns, and then you use the correlation function in Excel. It's CORREL in Excel, and it'll give you the correlation coefficient of those two sets of data. So, you'll end up between that -1 to +1 range, and it's really cool. I remember doing that in class. I'm sure if anybody here has also taken a college class and recognizes this visual, that's probably how they had you find it. But yeah, that's a little tidbit from there.
Very cool. And you could always, change it to the newer months as well, which is something that's very interesting, just to get an idea of how it's moving at this exact moment.
Right, right. I mean, you could plot this data. You could right now, if you really want to, and you want to just have a little project on your own. Pull data from the beginning of 22, plot it, plot it until the end of the year, and see what you can look back on and say, okay, this was a defined correlation, either positive or negative, in the year of 2022. And data helps, information helps.
Yeah, and there's a very easy and handy tool on TradingView which actually allows you to plot two charts over each other, which gives you a general idea of something is correlated. If we're trying to look for a correlation on the fly, that's something that we'll use all the time.
Right, right. Exactly. If you're looking for something really quickly and you just want a quick visual, overlay it on TradingView.
Yeah.
And if you really want to go into the nitty gritty, pull up Excel. It's really simple. I'm not a big Excel head, and this is a simple thing to do. So if you ever want to, definitely reach out. Feel free if you have any questions, or I'll send a link as well. But yeah.
Very cool. Austin, is this one you?
Oh yes, okay, yeah. You should probably do this one.
Okay.
Because
Yeah, no worries.
it's a little wordy, and I didn't write it.
Yeah. So convergence and divergence is going to be your best friend when it comes to trading correlations. And again, just starting off with some definitions here. Convergence is the process or state of converging or coming together, and divergence is the opposite, the process or state of diverging or going against each other. And I just have two quick examples here to kind of go over how you can use market correlations. So example number one, and both of these are going to be pretty recent events, so they should hopefully ring true to everybody. You notice an increased amount of volatility in crude oil due to the Ukrainian conflict, and you know that energy stocks are going to be very correlated to oil. Instead of trading oil directly, you position yourself in the direction you see oil going, but simply on an energy stock instead. This is a very easy and current example. This is an example of a positive confluence that is convergent. And if you've been able to do this recently, I myself have been able to take some good advantage of this correlation between oil and energy stocks. Playing energy stocks recently has been very fun, higher volatility due to those increased movements in oil. And the example number two is global markets are crashing. COVID is rampant and the stock market is plunging day after day. In times like this, investors are very scared of further economic growth, aka risk off, what we were talking about earlier, and are likely to pull their money into risk off assets as they think expectations are lower. You are a currency trader and position yourself in a currency pair that is a service-based currency versus a commodity-based currency, such as AUD/JPY. Short, as you know, AUD as a serviced currency will depreciate heavily, and the JPY as a commodity currency will appreciate rapidly. And this is actually the trade example that led to my largest P&L trade to date. And this is exactly the thought process that I had behind it. So those are just two quick examples of how you can use market correlations. Obviously, we could go into many, many different examples, but those are just two quick ones that everybody should be familiar with. COVID and the Ukrainian thing going on right now.
Yeah, I like how you mentioned that correlations are not only like a physical thing, like with material or which sector is using what with like a shortage, but it's also like very fundamental. And a great example of this actually, and this is like something happening right now. Twitter, that Elon Musk deal did not go through with Twitter, at least it's seeming like that. And because of that, Twitter's down roughly, or at least saw almost 8% down in after hours. Meanwhile, DWAC, Digital World Acquisition, is up over 10% in after hours. So they're completely divergent because, that deal didn't go through with Elon, so it's giving kind of more room to speculators on the flip side of that scenario. Kind of,
that's a great
Trump's
example.
Twitter.
Yeah.
And that's like a big fundamental event that's like playing out right in front of our eyes. So definitely I encourage you to check out the Twitter chart and the DWAC chart. Their after hours are complete opposites.
I might have to buy DWAC calls on Monday.
Well, that's what I was just about to say. A good trade idea. I mean, geez, I don't think this, and you know how DWAC runs, right? I mean, when it goes, it might take
go.
off on you. So
Absolutely.
yeah, pretty cool idea. And maybe Twitter will see some more downside. We'll have to see.
Very, very
Logan,
cool. What was that,
oh,
Ben?
did I interrupt something? No, I
Nope.
was just gonna say, I think I wanted to provide an example too for this, that it's interesting how you spoke about how the Bitcoin and tech has been the most correlated it's ever been.
Yes.
Right. It's at an all-time high for correlation.
And people, that's why I think there's also, and we talk about the macros all the time, but right now that's why there's a lot of uncertainty in the macro, I think, is because so many large asset classes are correlated right now. And so directionally speaking, when people are saying, oh, if this goes down, this might also go down with it. I think that's where a lot of concern arises when it comes to current market correlations.
Yeah, and I think for that reason, I think we might be in store for some kind of divergence. I'm not sure if everything's going to keep following the same path, to be quite honest with you. But that, if we see stuff start to diverge, then we can, recognize that and maybe make a trade out of it. So,
Right.
Yeah.
Definitely.
Right. I'm not saying, go leverage your Bitcoin because the Nasdaq might fall, but it is a good thing to keep in mind that these things do move in tandem right now, and it's going to be important to see if they continue to.
Absolutely.
Right. It's going to be very important. Yeah.
Well, that was all,
though.
Yeah, that was all that we had for you guys. We did want to leave some time for questions, and as of last week, we did go with a shorter format. It seemed like everybody liked it a lot. So now we can.
It's a lot more manageable for people. Yeah. Seems that way at least.
Especially on a Saturday. We don't want to keep you guys here too long. But now is the time for any questions. I hope that you guys learned something valuable. I think that is some key education that you need moving forward. I know that it's been working out for me especially well recently, keeping in mind correlations.
And I think a lot of people in here probably already understand a lot of what we just talked about, right? Like knowing that things correlate with each other. Like obviously, if you have a brain, you know that some things will move together. But really kind of taking like 30, 45 minutes out of your day to sit back and really understand how powerful these things are can help you out a lot, right? And like I said, it'll give you just that one little extra edge in your trading, right?
I wanna throw out a little personal anecdote, but one thing I think a lot of people, and Austin and Logan, you guys, I think will agree with this. Whenever I see something like a Futu or a Baidu or one of these Chinese equities, these major Chinese equities up, my eyes goes to Baba.
Yeah.
Why?
Yeah, absolutely.
Because I'm looking for a sympathy play, and that's just jargon for I'm looking for a correlation on a similar equity. So that's just like a little bit of an example of kind of how I would at least use this on like a day-to-day for certain situations.
Definitely.
Right. And another one, Ben, that's like right on the money with what you just said is like this Google stock split that's happening, right? I mean, look at all the sympathy tech got, right? You could have just, this Google, you wouldn't even have to play Google. You could have just went long the NASDAQ and been like done unbelievably well, right? Because you're understanding a fundamental correlation.
When NVIDIA is popping, you guys are playing AMD.
AMD, right.
There's like different, you can pick and choose, right? Maybe, and this is really specific to the options realm, but, I don't like the premiums on NVIDIA. I don't like how they move. Okay, well, let's move over to AMD. Their options chain works entirely differently than NVIDIA, but I'm getting similar price action. So, once you start to think like that, I think it'll give you also a little bit more agility when it comes to moving in between certain names as well.
Definitely.
Yeah, I couldn't agree more. Yeah. Yep. It's actually funny how often we use that stuff. We're always paying attention to market correlations.
Right? It's literally day to day, and it's almost subconscious. It's like, oh wait, I see this stock up. All right, let's go here because is there a correlation between these two for whatever reason? It's something day to day that we just do like subconsciously.
Right, and like paying attention to Apple as like the biggest stock in the stock market is like, how is this going to affect stuff, right? It's understanding that correlation.
Like if I'm trading SPY or SPX, I have a few things in front of me. I have VIX, Apple, and a few of the other big guys, Tesla, whatever. They're all in the same bunch on my trading view screen, so I can see them all at the same time. And those are the things I look at. I think for intraday traders, that would also help.
Definitely. Nick said thoughts on inverse correlation between inflation and small caps. I'm curious, Ben and Austin. Do you guys have any thoughts on that?
Yeah. So I'm there's two correlations I'm thinking of. Are you saying like when inflation goes up, why do small caps suffer, or can you use your mic? You can use your mic. You can talk.
Yeah, hello?
Hey, what's up, man?
Yo, what's up? Yeah, I was just thinking about ever since like the start of the year, basically, like we've just seen a huge, even last year, we've just seen the suffering of small caps. Basically, inflation's going off, and like when you think small caps, you think more of like risk on because it's easier to
Right.
move just because of the market size. So inflation goes up, risk off means like small caps. So I'm just thinking with all that information,
Well,
what do you
small
think
caps would be
about?
risk on, right? But that's
Yes.
why you're confused, right? And I think that happened because I think there was just too much money to be made in larger market cap equities, right? With like there was like more guarantee of returns. Um, and yeah, there was just no investor confidence this time around, I think, in that market. And it's also quite interesting. It's like, is cryptocurrency kind of stealing that penny stock market? I don't know. It might be, right? You have to remember cryptocurrency reached $3 trillion in market capitalization in the past year as an all-time high. So yeah, I think there could be a lot of reasons. But typically, Nick, in the past, you'll see penny stocks will do well in times of high speculation, right? But that just wasn't the case this time around.
Nick,
So I don't know.
just to add to that, Nick, too, I think this is very interesting because this is something that I was looking at a few months back, but regardless of the situation, our market was poised to make a turnaround. And typically, you'll see things like small caps make that turnaround prior to the larger markets.
When you say
Uh,
turnaround, you just mean like going bearish quicker?
yeah, like flipping
Yeah.
bearish, basically. Like small caps, they topped out around end of October, November. And then
Yeah,
we saw
yeah,
the
yep.
S&P top out, later, a little bit December, January. So, those things tend to, like Austin was mentioning, those things are seen as more inherently risky. And so, bigger money, other people will dump those quicker than they otherwise would, say, like an Apple stock, for example.
If things start to get iffy, yeah.
Right, right.
Right. Ben, do you think the penny stock market was affected by the introduction of cryptocurrency over the past 10 years? Do you think that
Um,
has any correlation? And I
I
want
don't
Logan's thoughts on that as well.
correlation in the sense of them moving together.
No, well, I think they have a little like I think a lot of the market share of like people who would have originally invested into smaller caps are looking over to other markets.
Yes, I think that there are people, I think there is a pool of people who, would want to invest in smaller scale, I'm going to use this term very
Like
generally,
higher return assets.
things,
Yeah.
yeah, assets or things for that matter, whatever you want to call
Securities.
them. And that they flock to crypto. But at the same time, the penny market right now, it's tough, man. I really don't know.
Well, it feels like the penny market's been in a bear market for like 2 years.
I think it's
That's what
going
it
to
feels
continue.
like.
I think it's just going to continue.
I mean, usually how these things work is these are penny markets are traded by retail traders. They just trade the pumps and the dumps. That's kind of like how that world works. And I think they got a little bit scared away. So we'll see. We'll see.
Yeah, Logan, do you think a lot of the speculators that were originally in the penny stock market have kind of moved?
I think that they are in the transition of moving. I think that in the next couple of years, as we're not printing as much money, and crypto is more widely accepted, I think that it's going to just pull even more of the market cap from penny stocks into crypto. But I think that we're in the process of transitioning right now.
Yeah, because I not even from like a price correlation perspective, but just like a sentiment perspective. I mean, I don't see anybody talking about penny stocks like
Right.
at all.
Right.
Maybe I'm just not involved in the community. I don't know.
You got to go on Wall Street
But
bets
like,
more.
but like 3-4 years ago, I feel like it was like a fairly big thing.
It was the
right.
thing.
You're like, what's the small market cap company that's gonna pop next, right? And now that's like
Because
not.
there was no crypto.
Well, there was crypto. There was absolutely crypto, but it didn't reach.
It wasn't as popular.
I feel like it reached.
It wasn't as
It
popular.
didn't reach. Yeah, it reached another level in the past 3 years. Right, crypto's been around for quite a long time, but it's just now that it's starting to become what it is. But yeah, that's really interesting. I got to look at some data for the penny stock market. I think that's really interesting, and I think some new interesting correlations might come about from that. We'll see, because I don't know when it's going to make its rebound. I have no idea. Why would you go invest in a penny stock when you could just go invest in any of these companies who already got absolutely annihilated that are much higher fundamental value?
It's a
Or
valid point.
any of that stuff, right?
Yeah.
So yeah, if anybody has any questions, please, I encourage you to speak up. You can use your mic. don't be afraid to talk, or go ahead and use the chat. Otherwise, right now we're just kind of blabbering along.
Yeah,
about good stuff, though.
Yeah, definitely. Was relating to the last question. But if anybody does not have any other questions, I'm sure we can just wrap it up shortly. Don't want to keep you guys here too long on a Saturday, again.
Cool. I think it's a good spot to end it, Logan.